Hey everyone, welcome back to my channel. Ben Morales here, your personal financial coaching consultant. I'm really excited about today's video because this is actually a 4-month update of a client that I've been working now since September of last year. So this client has just done an amazing job completing the first part of eliminating debt, and that was to eliminate all his credit card debt, the consumer debt that he had. But then he just stepped it up and took it to another level. He also eliminated an additional almost $20,000 in things that he had in mitigation, and he did what he had to do. And he got on the phone. He negotiated lower amounts with the companies that he owed, and those are sometimes things that you will have to do out of the norm. Don't wait for them to come to you and give you a lower amount. You have to get on the phone and negotiate that. So he was able to eliminate all his debt, eliminate those almost $20,000, eliminate his student loan, and he also stopped paying the attorney fees because when he got on the line and started negotiating for himself, they took his offer. So bam, he's completely eliminated all his debt. So I want to talk about where he was when we first started. Then we're going to take a look at what he's accomplished in terms of improving his cash flow and dropping his expenses. So this is where he was in September. Is actually of sorry about that, September 2024. His expenses were at $4,535, and he had a cash flow of only $1,848 that he was working toward, trying to pay off multiple different kinds of debt. At that time, his credit score was 669, right? And so if you'll see one of the other videos that I talked about is when we're trying to position yourself to get a home equity line of credit, which is what we're going to show what he did next. It's the closer you are to 700 and over, the better interest rate you're going to get. So right now, with everything that he's eliminated, he's actually at 701. So he's right there, right where he needs to be. So again, almost $25,000 in debt is what he eliminated. Now, currently, the only debt that he owes right now, Zen, is $94,989, which is to his mortgage. So absolutely fantastic job around that. That's the only other debt that is owed right now. So now, this is why I always tell my clients, don't stay with a bank that is not offering you a line of credit, some kind of revolving line of credit. If you're not getting that service from your bank, then look for another bank. And so this is exactly what we're doing in his scenario. His bank does offer him a line of credit, but as we started to do research, we found that there is a particular credit union, which I happen to have a more favorable opinion than I would of a bank, that will offer him a great line of credit. And so what we're doing is his value, home value right now is $245,000. Okay. One of the reasons that the credit union is better than the bank because it's going to allow him to go to 80 LTV, which is the loan to value, which will give him a line of credit of $196,000. But the real nice thing about this is this credit union is offering a 5.49 interest rate for the next 12 months. This is why I say, if your bank is not helping you, start doing your homework. So this is an absolute great deal for him because it's going to give him 12 months at that particular interest rate. And we're going to see what type of impact that's going to have to the balance that he has on his mortgage. So one of the other things that I believe that he has on his mortgage, which by the way, his payment is, so this is his payment right now, $1,149.28, which I believe it also includes a private mortgage insurance. So that helps him out nothing at all. That's just specifically for the lender to protect their interest. So what we're doing here is we're going to see the impact. What was this going to look like for 12 months at that particular interest rate? So this is month number 1. So we're going to see February. He's going to be using all of the income that he and his wife make, which is $6,683.46. He will be placing that income into the line of credit, okay, which is the 196,000 that he is going to um, get approved for. So that 196,000 is going to become the line of credit. In that 196, he's going to take the 94,000 of the mortgage and he's going to eliminate that. So now he's going to owe $94,989 toward that line of credit. But remember, when you're doing velocity banking and you take your income and you send it or you transfer it, however you want to call it, if you can get a checking account and a line of credit in the same bank, even better, because it's more easy for you to move money back and forth. But when you do that transfer, that income that you are putting into that line of credit becomes a payment. Okay, so that's exactly what we're calculating here. We're calculating throughout the course of a month a payment of $6,683.46, which is their income. Now, we know that every month there has to be expenses that are going to be paid. Those expenses are going to be paid through the line of credit, so they are no longer going to be utilizing a checking account. The line of credit becomes the checking account. That is where your income goes into. That is where your expenses come out of. Because the longer you leave your income inside of that line of credit, the less you pay in interest. Now, with the interest rate of 5.49 and a balance of 94,989, the most that they will pay in interest is $400.12. That is the most on this particular interest rate at that particular balance, right? So we know, as I mentioned, because the month is going to go throughout the course of the month, there will only be certain days when that balance will be at that particular dollar amount. The other days, the payments are going to be affected in dropping the actual interest amount that is being paid. So that is the max that they will pay. In February, because we're assuming that we're starting this month in February. So at the end of February, the beginning of March, the balance is $92,155.94. Okay, so this is the rinse and repeat cycle. We see the income going in, we see the expenses coming out, and we see the interest being added on. The reason why you see this interest is a little bit more higher than this interest is because March has 31 days and February has only 28 days. So that's why you see the discrepancy in the income. There's more days in this month to work with. We're going to go into April now. 89,352.42. Income is going in and expenses are coming out, so that's being added back onto it, and an additional $403.20 in interest, which after February, March, and April, right, we're going to end April with $86,522.48 as the balance. We're coming up here. So now we're into the month of May. So just a couple of months down into this particular 12-month cycle, we're trying to figure out what is this going to look like at the end of 12 months. Income basically going in, expenses coming out, interest is also being added onto it. That is our new balance in the month of June. Income, expenses, and interest. This is the new balance now in the month of July, $80,837.13. Income, same income's going in. If they happen to make more income, something happens, they get a promotion, they get a kind of a raise, whatever the case might be, then obviously it's going to make the numbers look even better. But the nice thing about it is because you don't have to pay the same bills or you don't have to spend the same amount of money throughout the course of the month on the same days, that interest is actually going to be less, right? I'm giving you the worst case scenario here in terms of income, right? We calculated this $376.96 of interest based off of $80,837.13 that we started the month with at that particular interest rate. So moving forward to the month of August, we're going to see that August now, we're already down to $77,226.86. We're going to, in that month, be using the income to bring the balance down. But we have to add back in the expenses. We also have to add back in the interest rates for that particular month, which means we finished that month at $74,353.90. This is absolutely amazing. And we're almost there at the 12-month cycle, but we're going to go ahead and we're going to look at September. and here's October. So there's nothing magical about this. It's just simple math and pretty much where you're putting your money to work for you and not work at the bank. So when you do a loan, and this is the beauty of using a line of credit, and I've said this before, how you borrow is more important than how much you borrow and what you're being charged for it. But when you do a loan, right, if this were a loan like you had before, then all that means is that the interest that you're being calculated as far as a payment, you're paying that up front. You're paying that right at the beginning of the month. So when the bank receives the payment, they're going to take the payment interest calculated off toward them first. The line of credit is not like that. The line of credit, the bank has to wait until the end of the day so they know how much is left in your balance, and then they apply the interest rate to that and calculate it for that particular day. That's why the lines of credits have average daily balances, is what is known as, to calculate your payments. So I think we finished in October 71,000, or September 71,546. Expenses or income is going in, expenses are coming out, as well as the interest for that particular month. That means that we're already down at 68,556, 19 cents. Moving right along, rinse and repeat, like I always say: income, expenses, and interest. So that means now in December, when this year ends, right, at the beginning of December, he's going to have $65,013.71. When December ends and the beginning of the new year, there will be a balance of $62,083 and $83.71. So here we are in January of 2026. Right? We still know that, because we did this for the 12-month promotion, we still know that the interest rate is still going to be at 5.49. So at that particular balance, the highest amount of interest that will be paid coming up in the new year, 2026, will be $288.92. So it's a great deal, because he's going to lock in that interest. Obviously, we don't know what 2026 is going to look like coming on, but we do know that with this particular rate, it's going to give him an advantage, because he's going to be able to put that interest more favorably into his best interest. So here's the month of January, and here we are the month of February. A year later, when February begins in 2026, he's going to have a balance of $59,139.45. The same income, and hopefully by that time his income's a little bit higher, or maybe by that time also his expenses have dropped as well. $6,683.46 is the income coming in. We're going to add the $3,450 of expenses, and this is the interest rate that he's going to have to pay for February of next year, $249.20. Now, that leaves his balance after February, 1 year later, at $56,155.47. So 1 year later, let's look at the numbers again. He started off with $94,989. Okay, he paid off down to $56,155.47. That means that in 1 year's time, he paid $38,833.53. Okay, and the total amount of interest paid over that 1 year period is $4,570.42, or you could average it out to $380.87 a month. So that is some fantastic, fantastic savings on his behalf. And in case you're curious, I went ahead and I continued to calculate what the payoff would be for that mortgage if we went ahead and maybe increased the rate. So I increased the rate because, again, we don't know what's going to happen after February of 2026. But we do know that for the first 12 months, it's going to be at 5.49. So I gave it a rate of 8%, and I calculated his payoff. And would you believe he finishes paying the balance of that mortgage off in another year and a half? So it takes him a total 2.5 years to completely pay off this $94,989 in debt. And folks, that is how you do it, utilizing Velocity Banking. Change where you put your money first. Get yourself a home equity line of credit if you have a home. If you can find a credit union that is offering you, or even a bank that is offering you some kind of special deal like this, jump all over it. So the benefit to him is he's staying at the 80% LTV, and over time, when he paid off all that other debt, his credit score jumped up to 701. So those are the two qualifying features, among other things, that are going to help you to get the best interest rate when it comes to a home equity line of credit. So there you have it, friends. You can see the power of velocity banking in action and the power of making the changes when the promotions are being available to you. So if you have any questions, please leave them down below. I'll be sure to get back with you just as soon as I can. Please continue to like, share, and subscribe to my channel as it continues to help it grow and continues to help me have more impact into the communities and the people that I'm trying to help better their finances. So thanks for your time for tuning in, and to the next video. Take care.